Hello, my name is Joe Hoyle, and I'm speaking to you today from the University of Richmond. And we're talking about financial accounting, and we're talking about the accounting that's handled for property and equipment. In this particular video lesson, we're looking at a very specific question. Your uncle owns an office supply store, and he has a store that is too far away, and he wants to exchange it for a warehouse. Now, this is a very typical accounting question. How do you make an exchange for one asset for another? There's one thing about this question that I really like. A lot of times, if you talk to students, they will tell you that the accountant comes in after the fact and figures out how to report what happened. And yes, that does happen. But that's not where an accountant is really valuable. Here, the accountant is called in beforehand, and the uncle says, here's what we're going to do. Tell me how that is going to be reported so I'll know how it's going to make my company look. So the accountant can help your uncle or help the person to understand whether this is a good idea from a reporting purpose. If all an accountant does is come in after the fact and just report, that's a fairly mechanical process that really doesn't add much value. If the accountant comes in before the transaction and serves as a consultant to talk about how that's to be handled, then the person who owns the company, your uncle in this case, can decide whether he wants to do this or not. Do I like the way this is going to be reported? Now, in this case, you're talking about property and equipment. So the basic accounting is always historical cost. What did the item cost us to get? We always start off with the historical cost if you're dealing with a building, land, a warehouse, or whatever. And historical cost is the normal and necessary cost to get the asset into position and condition to generate revenues. A fairly easy definition to work with. Is it going to get you to where you can start generating revenue? But in this situation, the uncle is not going to buy the warehouse. The uncle is going to give the store in exchange for the warehouse. So there's not a historical cost in the normal state. So what do? This is where a knowledge of U.S. GAAP becomes very helpful, because U.S. GAAP is going to give you the structure to tell you how this is to be done. Now, we're going to do this in a couple of steps. I'm going to assume that the exchange is being made sometime during the year. So the very first thing you would do is to record depreciation on the store that you're giving up first, because you have used that store in the current year to generate revenue. And any time you've used an asset to generate revenue, then the expense should be matched with that revenue. The depreciation should be recorded. So if the exchange is made, for example, on August 1st, then you have to record depreciation from January 1 to August 1, because the store was used to generate revenue in that time period. Now, what that does is it gets the net book value, the cost of the store, minus the accumulated depreciation, up to a date as of August the 1st. You are then going to exchange that for the warehouse. So the book value of the store is removed. The cost is taken off the books. The accumulated depreciation is taken off the books. And in its place, the warehouse is recorded. The whole question here, though, is at what figure do you record the warehouse? It doesn't have a historical cost in the same way that it would if you went out and bought it. Because you didn't pay money, you exchanged the store for it. Well, U.S. GAAP has a good set of rules here. Everybody, whether they're in Phoenix, Arizona, or Chicago, Illinois, would do this exactly the same way. The warehouse would be recorded at the fair value of the store. Now, why wouldn't they use the fair value of the warehouse itself? Remember, assets are recorded at historical cost. What are you giving up to get the warehouse? You're giving up the chance to sell the store. You're giving up the money you could have gotten from the store. So your sacrifice, your historical cost, is the fair value of that store that you lost. So if we're going to use historical cost, then what do we record the warehouse at? We record the warehouse at the fair value of the asset you gave up. So there's your journal entry. Now it won't balance, but there's your journal entry. You take off the old book value, which is the cost of the store and the accumulated depreciation, and you put on the fair value of the store as the new reported value for the warehouse. Now typically, net book value and fair value will be different. If the fair value is higher than the net book value, then you record a gain on the exchange. If the fair value is lower than the net book value, you record a loss, because fair value is rarely the same as net book value. Now there's only one more part to this rule that you need to know. One of the things about GAAP is that once you know the rule, you should be able to apply that rule to virtually any case like this. There's one more rule here. In some cases when you make an exchange, you will not know the fair value of the asset that you give up. Sometimes it's just not possible to get that number. In that situation, and that situation only, you record the new asset, the warehouse for this example, at its own fair value. Now the difference in the book value and the fair value is still a gain or loss. But if you know the fair value of what you gave up, then you record that for the the book value of what you receive. If you don't know the fair value of what you gave up, then you use the fair value of the asset itself. Now, if you know those rules, which is not very difficult, then you know exactly how to record an exchange of this type. Depreciate the asset up to the current day, take off the cost and the accumulated depreciation for the old asset, record the new asset at fair value. Use the fair value of the asset you gave up first, but if you don't know the fair value of the asset you gave up, use the fair value of the asset that you got. The difference in the fair value that you record and the book value that you gave up is either a gain or a loss. Effectively, that's how it's done. If you're in U.S. GAAP, if you're recording an exchange of this type, this is the way the accounting is done. And you can tell your uncle that information prior to his decision as to whether to make the exchange. That's where accounting can really be helpful to a business owner. This is Joe Hoyle. This is the University of Richmond. Best of all, this is financial accounting. We're looking at property and equipment. Hope you've got it all down. Take care.